Welcome back to the deep dive. Today we're taking a sharp left turn off the usual path. We're heading way north
Far north.
into the Arctic Circle. Our destination is Greenland, and our subject is one of the most distinctive and frankly paradoxical financial entities in the entire Nordic universe, GrønlandsBANKEN.
Or, as you'll see it listed on the Copenhagen Exchange, grla.co.
Right.
And it is a truly fascinating subject for an investment deep dive. What you have here is this massive, locally dominant bank.
Dominant is an understatement.
It really is. It functions less like a competitive commercial entity and more like essential critical infrastructure.
The utility.
Exactly. But its fate is tied to this microeconomy that's defined by, well, extreme structural fragility and, bizarrely, global geopolitical speculation. It's an investment defined by extremes.
Absolutely, and that combination is why we chose this. Our mission for you today is to process a really comprehensive investment analysis that's been done on this unique bank.
And the goal is to distill the core investment thesis.
Exactly. When you cut through all the ice and the hype, is this an unmissable investment because of its unparalleled monopolistic power, or is it structurally constrained, trading at a cyclical peak, and ultimately a value trap just waiting for the icy waters of macroeconomics to close in?
To really get the scale of this institution, you have to understand the market size.
Okay.
The bank serves approximately 50,000 customers.
50,000.
Now, you have to compare that to the fact that Greenland's total population is only about 56,000 people.
Wow, so that's basically everyone.
It's a level of penetration that's almost unheard of in the Western world. It means GrønlandsBANKEN commands an estimated 80% market share
80%.
in both the private and the small to medium enterprise segments.
Yeah.
So when we say it's critical infrastructure, we really mean it. The alternative is almost non-existent for the average person in Greenland.
That concentration of power is the core of the paradox we have to wrestle with, right? How can a bank be so powerful locally, a virtual utility, and at the same time be so completely constrained by the finite size of its geography?
Well, the analysis suggests there are three critical pillars for understanding whether GRLA is a buy, a hold, or a sell right now.
Okay, let's lay them out.
That's the roadmap. The first pillar is this tension between monopolistic resilience versus structural stagnation.
Okay.
They have built an undeniable deep local moat. And we'll show you the financials that prove that moat exists. However, that moat is strictly, geographically bounded.
It doesn't travel.
It doesn't travel. They cannot organically grow beyond the ceiling of a 56,000-person economy, and that dictates everything about their capital strategy.
Right. And the second pillar, and this is what makes this deep dive so urgent, is what the analysis calls the earnings cliff.
This is the big one.
Our sources show the bank is exiting a phenomenal financial supercycle. We are talking record profits, driven primarily by two external forces: high Danish interest rates and a huge localized construction boom.
And the forecast is for a steep material earnings contraction, starting sharply in 2026. This is that moment when the market is looking at peak performance results, but they're in the rearview mirror.
Right. And then there's the third pillar, which just adds enormous complexity and, frankly, a lot of market noise.
This is the wild card, geopolitical mispricing.
The meme stock factor.
It's sort of acting like one, yeah. We've seen the share price surge dramatically in recent periods, and it's been fueled almost entirely by speculation about increased U.S. and NATO strategic interest in Greenland.
So this speculative high-flying layer is basically masking the deterioration of the underlying banking fundamentals.
That's the argument, yes.
So, before we even start the formal analysis, let's set the initial question we're chasing here. Is GRLA a genuine growth equity? A business that can compound capital at stellar rates over a decade? Or is it, in reality, a highly specialized, high-yield bond proxy?
Something designed primarily just to pay out its profits, but with this added complication of volatile geopolitical tail risk.
Let's unpack this. Let's start by grounding ourselves in the engine room, the core business model.
Right. To understand the valuation, especially why it surged so high, you have to first appreciate the operational reality.
Okay.
GrønlandsBANKEN's core business model is defined by, well, necessity and its location. It's extremely simple compared to any European peer. You won't find proprietary trading desks or complex financial engineering here.
So it's traditional spread banking.
Exactly. Deposits versus loans operating in the extreme north.
Simplicity often means robustness, though, particularly in volatile regions. If they aren't chasing volatile trading income, what is the main driver?
It's almost entirely driven by net interest income, or NI. This is the undisputed engine of profitability. And the critical, unique structural feature driving their NII is their massive structural deposit surplus. This bank is fundamentally what we call asset sensitive.
Meaning its profitability reacts positively and very quickly when interest rates rise.
Very quickly.
Okay, so let's define that deposit surplus clearly, because this is the source of the free lunch that has defined the last 2 years of record profits.
Absolutely. The metric that tells the story is the loan-to-deposit ratio.
And what's that at?
It hovers consistently around a very low 70% to 75%.
Okay, so think about what that means. For every, say, 700 kroner they lend out.
They have 1,000 kroner sitting in stable customer deposits in the vault. They are just flush with liquidity, which analysts often label lazy capital.
Lazy capital.
The bank simply cannot find enough profitable, credit-worthy borrowers within the limited Greenlandic market to lend all that capital out locally.
Wait, so having too much cash sounds like a good problem, but it suggests management isn't finding enough good projects to fund. Is that a sign of internal weakness or just the external market reality?
It's purely external market reality.
Mm-hmm.
They're being prudent. The local economy is so small and so dependent on, the government and fisheries that the risk profile for new non-essential lending is just very high.
So instead of making risky local loans,
It's safety. They have to park that excess cash somewhere safe, and that's either in low-risk Danish government bonds or, crucially, with the Danish central bank.
and this is the magic trick we talked about. This is the free lunch.
Exactly.
Yeah.
And let's put a concrete number on that free lunch to show the impact. Assume the bank has, say, 3 billion Danish kroner DKK, 3 billion excess deposits parked at the Danish central bank.
Right.
When the Danish policy rate was near zero, they earned nothing on that capital. It was just sitting there.
Right.
But if the central bank raises that rate, say, from 0% to 3.5%, as it did during the recent cycle,
What happens?
that immediately translates to DDK 105 million flowing directly to profit before tax.
105 million.
And that DKK 105 million comes with zero operational effort, zero credit risk, and zero compliance cost.
Yeah.
It was a sudden, huge structural windfall that they've been enjoying.
And one that they are now exiting. That is a phenomenal example of external macro factors, rates set 2,000 miles away in Copenhagen dictating local prosperity. But NII isn't the whole story. What stabilizes the income during the downturns?
Well, they have stable fee and commission income because they are, in effect, the payment processing backbone for the entire island.
Every transaction.
Every credit card swipe, every wire transfer, every utility bill payment generates a stable fee for GRLA. They also have a guarantee business that's been volatile but massive, tied directly to that construction cycle we mentioned.
The one that's been booming.
Right. But one area that provides some complexity is their pretty substantial proprietary investment portfolio. This includes holdings in entities like Bank Invest, DLR Credit, and BI Holding.
Why do those investments complicate the picture?
They create significant non-core volatility through quarterly market value adjustments.
Mark to market.
Exactly. If bond yields or equity values shift, those changes hit the P&L immediately, sometimes in the tens of millions of kroners. This can often obscure the underlying, more stable core banking trends that an investor really needs to be focusing on.
Okay, so let's pivot from the operational simplicity to the structural complexity. You can't discuss the safety of this bank without discussing the Danish block grant. How does that foundation factor into the bank's stability and, more importantly, its credit risk profile?
It is the absolute sovereign floor. It prevents the Greenlandic economy from collapsing entirely.
It's a backstop.
A huge one. Greenland is not and has never been fiscally self-sustaining. It relies heavily on an annual block grant from Denmark, which in 2024 was approximately DKK 4.8 billion.
4.8 billion. And to put that in perspective,
That grant covers roughly half of the public budget.
let's just pause on that. That level of risk subsidy is huge. If that grant stabilizes the public budget, it must indirectly stabilize the bank's loan book tremendously.
Completely. The grant effectively subsidizes the credit risk across the entire public sector. Public employees, government institutions, state-owned enterprises. They form a massive, stable portion of the bank's borrower base.
So a huge chunk of their loans are indirectly guaranteed by Denmark.
In a way, yes. Without that Danish guarantee, the risk profile of GRLA's entire loan book would skyrocket overnight. But with the grant, the credit risk is fundamentally dampened, making their loans inherently safer than they might otherwise be in a volatile mono-economy dependent on a single resource like fisheries.
It creates an almost perfect tension. They're local financial giants, but their ultimate safety and stability are rooted in the continued political will of a foreign sovereign entity.
That's it exactly.
What about regulation? Does a bank this size face the same regulatory headaches as, say, Danske Bank?
It's the worst of both worlds, really.
Yeah.
Despite their minuscule size, we're talking DKK, 10 billion in assets, a drop in the ocean for Nordic banking. They are fully regulated by the Danish Financial Supervisory Authority,
The FSA.
the FSA. And this means they are subject to the full EU framework. GDPR, anti-money laundering standards, capital requirements regulation, the works.
So the cost of compliance for this tiny market must be immense.
It is. And it acts as a massive financial barrier to entry. They have the complexity of a large European bank, but the revenue base of a small regional lender.
And our sources highlight two specific regulatory burdens, sci-fi status and MREL. Can you explain the practical effect of those for the bank's profitability and capital strategy?
Here, the sci-fi status systemically important financial institution is a classic good news, bad news story.
Okay.
Locally, it confirms their too big to fail status. The government cannot let GrønlandsBANKEN collapse. It would shut down the entire payment system. But this designation is what triggers a requirement for higher capital buffers, specifically a systemic risk buffer. This forces them to hold significantly more equity than they would if they were just a normal commercial bank.
And that equity, that lazy equity as you called it, provides immense safety but structurally depresses their return on equity.
Precisely.
Yeah.
Because you have a larger denominator, the equity base, for the same amount of profit. Safety comes at the cost of shareholder return potential.
And what about MRL?
MREL stands for the minimum requirement for own funds and eligible liabilities. This requirement came out of the financial crisis and is all about resolution planning.
Making sure the bank can be wound down or bailed in without taxpayer money.
Exactly. And to meet this requirement, GRLA is obliged to issue specific types of unsecured debt instruments, like Tier 2 and senior non-preferred debt.
Can you give us an analogy for what MREL means practically?
Think of MREL as a mandatory high-limit emergency credit card they have to carry.
Okay, I like that.
It's an assurance policy for the Danish FSA. They have to pay a small but continuous annual fee, the interest payments, to keep that credit line open, even if they never use it. Issuing this type of debt adds cost. It increases their overall cost of capital compared to a bank funded purely by those cheap, sticky retail deposits.
So regulatory necessity imposes a structural, continuous drag on their margins.
Yes, they are constantly balancing the high fixed costs of compliance with the reduced ROE from holding all this necessary but excessive capital.
The structural context is now clear. High external risk offset by subsidized credit risk and high internal regulatory burdens. Now we can turn to the moat. This is a competitive advantage that justifies any premium valuation. But here, the moat is less about technological innovation and more about geography, cost structure, and, well, sheer inertia.
Precisely. We label it a narrow but deep moat. It's narrow because they can't export that advantage.
Right. The expertise of running a bank in the Arctic doesn't help you in New York or London.
Not at all.
Yeah.
But within Greenland, it is extremely deep. It's almost a fortified, unassailable position.
So tell us about the competitive landscape. It's not a monopoly, but it is a duopoly.
Correct. GrønlandsBANKEN, GRLA, is the undisputed incumbent, the behemoth, holding that 80% market share and immense brand inertia. They are seen as the Greenlandic bank.
And the challenger, Bankavik, who are they?
Bankavik, which was formerly known as Bank Nordic, is the challenger. They hold roughly 20% of the market. And they're actually a branch of the Faroes Bank, Banki.
Okay.
What's fascinating is their recent strategic maneuver, which really highlights GRLA's advantage. In late 2024, they rebranded specifically to Bankavik.
A name derived from the Greenlandic language.
Exactly. It was a direct, explicit attempt to combat the deep-seated stigma of being perceived as the foreign entity and to try and tap into that powerful local identity and patriotic affinity GRLA has leveraged for decades.
That rebranding effort really shows how important that intangible concept of being local is in this specific micromarket. But despite this, our sources suggest competition remains remarkably rational. Why? Why aren't they in a vicious, predatory price war?
They both realize they're fishing in the same small, finite pond.
Right?
The total addressable lending market is microscopic by Nordic standards. We're talking DKK 6 to 7 billion in total lending.
That's tiny.
It's tiny. If GRLA and Bankavik engaged in aggressive predatory pricing, say slashing mortgage rates down to uncompetitive levels, they would instantly destroy their own operating margins for a minuscule gain in overall volume.
It's a textbook case of rational oligopoly behavior.
Absolutely. Maintaining the status quo preserves profitability for both players. If one uses dynamite, they both lose the fish.
And the defensive layer we discussed earlier, external insularity. Why are major Nordic banks, the true giants like Danske Bank or Nordea, content to just ignore this opportunity?
For them, Greenland is purely a rounding error. The potential revenue, even if they successfully captured 50% of the market, would be negligible relative to their group revenues.
But the cost and complexity would be massive.
Huge. They'd have to set up operations subject to Danish compliance rules, the full EU stack, deal with the extreme logistical headaches of servicing remote settlements, overcome the cultural hurdles, and hire specialized staff in a place where labor is scarce.
It's just not worth the management headache.
Not for the potential return. And this reluctance acts as the perfect protective shield, insulating GrønlandsBANKEN from any global disruption.
And this external insularity leads directly to the primary financial moat, the concept of minimum efficient scale.
That's it. Operating a fully compliant bank in the Arctic involves these immense fixed costs. GRLA has the structural advantage of spreading these high fixed costs over its DKK, 10 billion in assets, giving it the lowest cost-to-income ratio in the region.
And we're talking about more than just high utility bills, right? We're talking specialized infrastructure.
Exactly. The costs are dictated heavily by regulation and geography. Think about the IT security required to meet EU standards for data protection and resilience. That doesn't scale down cheaply.
Or the anti-money laundering requirement.
Right, which are complex to enforce across a decentralized set of remote settlements. Then you have specialized staff costs, often requiring imported labor, and the crucial logistics and translation requirements for a bilingual territory.
So a potential third entrant would face the exact same high fixed costs, but would have to spread them over a tiny initial revenue base. GRLA's scale gives it a structural cost advantage that is nearly impossible for a newcomer to overcome. It makes the business inherently sticky.
And what about the existing customer base? Is GRLA counting on inertia, or is there a genuine difficulty in switching?
There are definite moderate switching costs, which are reinforced by inertia. GRLA is deeply integrated into the entire local payment infrastructure. Payroll, public transfers, the Danish Greenlandic nemkonto system.
GRLA is the primary interface. It is. So switching banks requires this administrative friction that many customers, particularly the elderly or those in smaller remote settlements, they just avoid it. Plus, GRLA is actively investing in digital solutions to reinforce that customer stickiness, making the perceived hassle of switching even greater.
Okay, so a moat only matters if it tangibly appears on the balance sheet. Let's look at the numbers that prove this advantage translates into superior performance.
The bank's financial history consistently supports the thesis that this is a genuinely high-quality business operationally. The clearest evidence is the return on equity, or ROE.
Okay.
GRLA has consistently delivered returns well above its estimated cost of equity, which for a bank operating in a volatile periphery, we'd place it around 8% to 9%.
So give us the peak numbers that attracted so much attention.
Well, the recent pre-tax ROE figures are stellar. 17.5% in 2024 and a staggering 18.9% in 2023.
Those are top quartile returns compared to most Nordic and European banks.
They really are.
Yeah.
But what's even more compelling is that GRLA maintained a strong double-digit ROE around 10–12%, even during the decade of the zero interest rate policy, the ZRRP era.
Right, so that proves they have structural pricing power and operating efficiency that goes beyond the temporary boost from high interest rates.
It does, and that ties directly back to their primary structural metric, the funding advantage.
The low loan-to-deposit ratio.
Correct. That 70% to 75% figure, it's a gold mine. It means the bank is entirely self-funded by cheap, stable retail deposits. They avoid the volatile, expensive wholesale funding markets, which are the Achilles heel for many larger commercial banks. This free float is a major, resilient competitive advantage.
And finally, let's just ensure these high returns aren't built on a risky foundation. What does their asset quality look like?
Historically, their underwriting has been conservative and high quality. They have maintained exceptionally low non-performing loan or NPL trends. Their impairment ratio was a tiny 0.2% in the first 9 months of 2025.
That's very low.
It is. And furthermore, the bank maintains a very conservative, deliberate cushion. They hold a significant DKK 38.1 million management estimate or overlay buffer.
So that's cash just set aside.
To smooth earnings and protect against future non-specific macro shocks. It shows prudent management that values safety over short-term maximization.
So we've established GrønlandsBANKEN is a high-quality, defensively structured local monopoly. But now we must confront the central danger in the investment thesis, that all the numbers we just discussed are rearview mirror financials.
Right.
The peak of the cycle is definitively over.
That is the crux of the bearish argument, and the data is already confirming it. Investors who buy today expecting 2024 results are making a massive mistake.
Okay, so let's nail down the peak performance first.
The bank achieved a record profit before tax, PBT, of DKK 245.7 million in 2024.
That was the high watermark.
It was the maximum benefit delivered by the combination of soaring Danish policy rates and that massive local construction boom.
But the Q1, Q3 2025 interim reports show the painful inflection point is already here.
They show a dramatic, sharp drop in profitability. PBT fell year over year by a staggering 31% to DKK 132.5 million in the first 9 months of 2025.
31%.
And crucially, net interest income, the engine that was revved up by that free lunch, is already down 10%. This proves the interest rate windfall is receding rapidly.
How exactly are falling interest rates causing so much pain so quickly given their monopolistic position?
It's the flip side of that asset-sensitive deposit surplus. When the Danish central bank cuts its policy rate, the yield the bank earns on that huge pile of parked excess liquidity vanishes immediately. Right. That money market income stream just disappears.
But their funding costs, the rates they pay on deposits, are sticky downwards.
Exactly. They can't realistically drop deposit rates below zero, and competition from Bankovic prevents them from cutting too aggressively, otherwise customers will switch. So they face severe margin compression because the rate they earn on their assets falls much faster than the rate they pay on their funding.
So the structural advantage of having cheap deposits turns into a structural disadvantage when rates fall towards zero, and management seems completely transparent about this pain being unavoidable.
They are. Management guidance for 2026 explicitly forecasts a significant contraction in PBT, projecting a range of only DKK 145 to DKK 175 million.
So when you take the midpoint of that range and compare it to the peak in 2024,
you're looking at a forecasted 30% to 40% erosion in core earnings power. This is management's clearest admission that the supercycle has ended and core earnings are resetting to a dramatically lower baseline.
any investor must discount the share price by at least 30% just to account for this reset.
You'd have to, yes.
And the earnings cliff isn't solely about rates, it's also about the local economy stalling. Greenland's recent growth figures have been artificially inflated by construction, right?
Entirely. Lending growth and fee income throughout 2022 to 2024 were primarily driven by massive, non-recurring, government-backed infrastructure projects.
The airports.
The major expansion of international airports in Nuuk, Ilulissat, and Qaqortoq. These projects required huge financial guarantees and financing for local subcontractors, which was a low-risk, high-volume lending boom for the bank.
And those projects are now winding down.
They're nearing completion in 2025 and 2026, and this creates a severe growth cliff. The core existential question facing GRLA's lending department is what structurally replaces that massive, low-risk, public sector-driven lending volume.
Because commercial lending outside of that framework is much smaller and higher risk.
And far less scalable. There is simply no other comparably sized government initiative on the books.
So if the bank wants to grow, it needs the economy to diversify. But our sources show extreme, almost terrifying dependence on a single sector.
Extreme dependence is the understatement. Seafood, primarily cold water shrimp and halibut, accounts for over 90% of Greenland's goods exports.
90%.
The bank's entire corporate loan book, and much of the retail income base, is inextricably linked to the cash flows and prices of this single volatile sector. This is the single largest concentration risk they face. It dwarfs all others.
And what's the latest scientific data regarding the health and management of that crucial fisheries sector?
It's troubling, and it presents an immediate downside risk. Recent biological advice mandates a substantial shrimp quota cut.
How much?
Approximately 27% for the 2025 season.
Wow.
This is a material, non-cyclical risk driven by biological mass decline, likely due to climate change-induced warming or shifts in predator populations like cod. If that biological mass collapses further, it poses a direct, immediate threat to corporate cash flows, leading to loan impairments.
And simultaneously crushes retail disposable income, leading to higher NPLs across the board.
Yes, the bank is highly exposed to the potential of a fisheries trap.
So the bank is essentially one bad biological season away from a regional recession. Beyond the fisheries trap, what are the demographic realities that cap their long-term growth potential?
Well, the addressable market is a hard ceiling capped by the 56,000 population. Furthermore, structural demographic issues are worsening. Greenland faces a serious aging population problem, and crucially, the emigration of skilled labor to Denmark.
So the young, educated citizens are leaving.
They're leaving for better opportunities abroad, which limits the potential for new business formation or long-term high-value mortgage originations. This caps Greenland's GDP potential to a meager forecasted long-term growth of 0.9% for 2024 and 1.1% for 2025.
So GRLA is a monopoly that cannot structurally outgrow the tiny, shrinking economy it serves.
That's the trap.
Okay, so we have this fantastic low-risk utility hitting a structural earnings cliff, facing a population constraint, and exposed to a quota cut. Yet if you look at the recent share price action, you would think they had just discovered oil.
Right.
This brings us to the bizarre driving factor, geopolitical mispricing.
That massive surge in the equity is the definitive problem for new investors looking at the current price. The stock acted like a rocket in early 2026 on renewed speculation regarding United States strategic interest, possibly asserting control, or even revisiting that old idea of purchasing the island.
This is the geopolitical meme stock surge we mentioned. I want to challenge you on this.
Yeah.
Even if the U.S. does significantly invest in Greenland for military or strategic purposes, why is that narrative so financially disconnected from the bank's core reality for minority shareholders?
Because geopolitical maneuvering, while dramatic, provides zero immediate tangible cash flow benefit to the bank's minority shareholders.
Zero.
A treaty signed between Washington and Nuuk doesn't automatically boost the bank's core NII or fee generation tomorrow. The market appears to be pricing in a speculative premium that assumes a complete economic restructuring, a massive guaranteed capital flood, or even a strategic acquisition of the bank.
None of which is guaranteed.
And neither scenario is likely to materialize quickly or cleanly. The narrative assumes that if America cares about Greenland, they will automatically care about GrønlandsBANKEN's share price.
Right. And this high-flying speculation has pushed the bank's valuation multiples far beyond their historical average without any fundamental support from earnings.
Exactly. The bank's current price-to-book, or PBE ratio, is trading between 1.0x and 1.2x.
And historically?
Historically, a bank like this, constrained and facing concentration risk, should trade at a discount to book value, typically around 0.8x to 0.9x.
So that difference between 0.8x and 1.2x PB, that 30% to 50% premium, is purely speculative.
It is the Trump premium, or the geopolitical premium, whatever you want to call it.
Mm-hmm.
It lacks any support from actual earnings forecasts and creates a massive event risk.
Right.
If the geopolitical headlines fade, if the U.S. shifts focus, or if a political agreement disappoints, that premium could evaporate overnight.
Leading to a significant unrecoverable drawdown.
The 20% to 30% drawdown, easily. The stock price today is being dictated by political analysts, not banking fundamentals.
Let's pivot back to the balance sheet, which, speculation aside, is pristine. We mentioned the extreme regulatory requirement for large capital buffers. Let's quantify that safety.
The bank is massively, almost comically, overcapitalized. As of Q3 2025, they reported an ultra-high solvency ratio of 25.7%.
25.7%, and their required capital is?
The required capital, including all the buffers from the SATFI status, is approximately 11%.
So they're holding more than double the necessary capital.
More than double. It sounds incredibly safe for depositors, but it's disastrous for shareholders seeking high return on equity.
It's the definition of inefficient capital deployment. It's that lazy equity again.
It is. Capital that just sits there, acting as a massive safety margin against the extreme concentration risk of the Greenlandic economy, but structurally depressing the ROE.
Which is why management has adopted this very rational and shareholder-friendly harvest mode strategy.
Exactly. Management, led by CEO Martin Fiesgaard since 2006, understands the structural limitations of the bank. Since they can't grow, they maximize distribution.
So it's a strategy focused entirely on returning cash on shareholders.
Entirely. They paid a substantial dividend of DKK 100 per share in 2024. Based on that peak year's earnings, that implies an ultra-high payout ratio of nearly 86%.
86%.
It signals clearly that the bank is operating in permanent harvest mode, acting as a pure yield instrument rather than compounding capital internally for future growth.
And buybacks complement that. They're using buybacks to engineer their way to a higher, albeit artificial, ROE.
Exactly. They actively use share buyback programs to manage that persistent excess capital. They executed a DKK 385 million buyback in 2023, and they have a DKK 1 billion authorized program running. The intent is crystal clear. They are a cash cow, a reliable yield instrument, but they are not a growth stock.
They're giving the money back because they can't find a better use for it in Greenland.
That's the long and short of it.
This dual reality forces us to look at valuation through two vastly different, even contradictory lenses. Let's compare the trailing PE versus the forward PE.
Okay, so based on the phenomenal peak performance of 2024, which generated that DKK $245 million in profit, the trailing price to earnings, or PE, ratio looks cheap, perhaps around 9x.
And this is the metric used by speculators to create the illusion that the stock is undervalued.
The illusion of cheapness, yes, a deep value play, but that illusion completely ignores management's own sober forecast for the future.
Right. So when you factor in the much lower 2026 management guidance,
That PBT range of DKK 145 to DKK 175 million, the picture changes dramatically. The reality check is harsh. The forward PE jumps to an expensive 14x to 16x.
paying 14 to 16 times earnings for a bank that management itself forecasts to have negative 30 to 40% earnings growth while facing severe macroeconomic and biological headwinds. It sounds like a textbook definition of a value trap.
It's fundamentally difficult to justify. The current stock price is priced for a high-growth trajectory that Greenland's economy cannot possibly sustain, especially at this late stage of the cycle. The historical valuation of 0.8x book and 8x PE was appropriate for its actual risk and growth profile. The current premium is entirely speculative noise.
Okay, let's consolidate the analysis by looking at the core downside risks. What are the material threats that could cause that speculative premium to vanish rapidly?
Number one is the most immediate. It's confirmed by management. Interest rate sensitivity. The 2026 guidance is the canary in the coal mine. Due to that massive deposit surplus, the bank suffers disproportionately when rates fall,
Because the margin on the park's liquidity vanishes faster than they can cut their sticky deposit rate.
leading to severe margin compression.
Right. Risk number two is structural and biological, the fisheries trap.
The 27% cut in shrimp quotas for 2025 is a material threat that affects the foundational cash flows of the entire island. If that biological mass continues to collapse due to external forces, the entire economic cornerstone of Greenland is hit.
And that impacts NPLs in both corporate and retail books simultaneously, a non-diversifiable risk.
Exactly. Then you have the risk related to the construction boom ending the infrastructure hangover.
The lending demand cliff.
There's the cliff, yes, as those major airport projects wrap up. But the risk goes deeper. If those new airports fail to attract the long-haul tourist and freight traffic projected,
Which relies on factors completely outside GRLA's control.
then the public entities owning the airports could face financial strain. This, in turn, threatens the stability of public sector revenues and causes a sharp demand drop for the local subcontractors who borrowed heavily to capitalize on the boom.
We also have to consider the long-term existential risks unique to the Arctic, the physical effects of climate change.
The climate change, physical risk, is immediate in Greenland. Thawing permafrost is not a future problem. It is actively damaging infrastructure and housing foundations right now.
And that property devaluation impairs the real estate collateral used to secure their loans.
Right. And crucially, this type of foundation risk is increasingly difficult and expensive to insure against, meaning GRLA effectively inherits that liability directly on its balance sheet.
Finally, the practical risk for any large investor looking to buy or sell this stock, liquidity risk.
The stock is incredibly thinly traded. We are talking about small volumes moving the price significantly. So if you're a fund manager or a large institutional investor, exiting a substantial position during a market downturn,
Say, triggered by a bad fisheries report or a sudden drop in Danish rates.
it could be difficult or even impossible without triggering a significant self-fulfilling price collapse. Low liquidity compounds all other risks, making the stock highly volatile on the downside.
Okay, let's lay out the two competing narratives for the listener to weigh this complexity. What is the most optimistic, rational argument for buying GrønlandsBANKEN now, even with all these obvious headwinds? The bull case.
The bull case views it as an indispensable, high-yield strategic asset. First, you have guaranteed profitability. The structural monopoly ensures it will always be a profitable, necessary business.
Second,
Sustainable high yield. Because it's so overcapitalized and has no growth opportunities, it can sustain a generous dividend yield, historically around 10% to 11% based on 2024 payouts, making it a superior bond substitute.
and the geopolitical angle.
The geopolitical upside. If U.S.-NATO investment does eventually ramp up, channeling large sums of capital through the island, GRLA will be the primary financial conduit. And finally, it's a defensive haven. Its zero exposure to complex derivatives and that 25% plus solvency ratio make it an isolated safe harbor if global markets crash.
Okay. Conversely, what is the most compelling argument for avoiding the stock at these elevated levels? The bear case.
The bear case views it as a classic value trap. First, you are buying at the peak. You are entering the trade with explicit management guidance pointing toward an unavoidable 30% earnings decline for 2026.
That's a huge headwind.
It is. Second, negative operating leverage. Operating costs are sticky while cyclical revenue is falling fast, crushing margins. Third, single sector dependence on the volatile fisheries sector, which is facing that material quota cut. And finally, valuation distortion. The current price holds a volatile, non-fundamental Trump premium that is not backed by earnings. When that fades, the stock price will revert violently downwards.
So after this extensive deep dive into the regulatory landscape, the economic structure, the political noise, what is our final conclusion for you? Is GRLA a good business or a good investment at this price?
The conclusion is precise, and it requires separating the quality of the business from the attractiveness of the stock price. GrønlandsBANKEN is a high-quality, stable business. It's market-dominant, extremely well-managed. However,
It is currently trading at a cyclical peak valuation, distorted by external speculation.
that's it. So the final verdict is,
It is a bad investment for capital appreciation at current prices. The forward PE of 14 by 16x is simply too high for a structurally X-growth bank facing a guaranteed earnings contraction.
but if you are a defensive, income-focused investor with a high tolerance for low liquidity, it remains a viable, defensive, high-yield bond substitute that will continue to harvest and distribute its excess capital.
Timing is everything here.
And the current timing for entry is poor. To synthesize this, let's look at management's attempts to overcome the structural stagnation. Recognizing the construction demand cliff, the bank has allocated DKK 100 million in growth capital, specifically for the tourism sector.
The pivot.
A critical pivot, but one that is fraught with challenges. Consider the obstacles. Tourism is severely constrained by labor shortages, limited hotel capacity, the sheer logistics of an Arctic destination. How difficult will it be for this nascent tourism sector to generate the same level of secure, high-volume, government-backed lending demand as those massive, low-risk, state-sponsored airport projects did?
It represents a difficult transition from guaranteed low-risk growth to higher-risk, smaller-scale commercial development. And that transition really defines the future risk of this bank. And that leads to one final provocative thought for you to consider. We learned that GrønlandsBANKEN is designated sci-fi, too big to fail, within Greenland, implying state support in a crisis. Yet the entire economic foundation of the territory, and therefore the stability of the bank's core assets, is reliant on that DKK 4.8 billion annual Danish block grant.
Right.
So what does it truly mean for a financial system to be systemically important locally when its ultimate stability, its ultimate sovereign floor, relies entirely on a foreign government?
It raises powerful, almost philosophical questions about the true nature of economic autonomy in the modern geopolitically contested Arctic.
It certainly puts into perspective how thin the veneer of independence can be when the financial lifeline is held elsewhere. We hope this deep dive helped you parse the complex layers of risk and opportunity surrounding GrønlandsBANKEN. Always consider how external, unmanageable macro forces like the Danish interest rate policy or the health of a single biological resource can dictate the fate of even the most dominant, ironclad local monopolies. Thank you for joining us.